I am joined once again by Dr. Jane Knodell, professor of economics and financial history at the University of Vermont. Professor, so glad to have you back. Welcome back.
Thanks, Jack. I'm happy to be back. Looking forward to our conversation.
Since we last spoke, the U.S. banking system has encountered some stresses. Some people are calling it turmoil. Other people are calling it a crisis. The three, the bank failures, Silicon Valley Bank, Signature Bank, and the attendant news around it. When you look back, what are sort of the historical analogs that stand out? And is this kind of par for the course of, oh yeah, this is exactly like the same thing that happened in 1890, whatever? Or is there something really new that stands out to you?
Of course, we're all hoping that things will calm down. And there's some signs that it is calming down. But I guess what struck me, say with Silicon Valley Bank, is that their problem was not credit risk. In other words, loans that weren't getting repaid. Their problem was the long-term government securities that they had on their balance sheet that, because of the rapid increase in interest rates over the past year due to the Fed's anti-inflation policy, the market value of those securities has gone down significantly, right? And so this is a problem of, that their balance sheet had a mismatch between the deposits that are payable on demand and the longer term assets that they're holding, right? And that was a problem that came up in the banking crisis of the 80s and 90s. And so what's interesting, I think, first thing that comes to mind is these banks, and they were not alone. There are lots of banks that did the same thing, got very used to a low and stable interest rate environment. And they just kind of assumed that was the way things were going to be. And so they didn't plan for the Fed to increase interest rates dramatically. I think they bought this idea that everybody had that, we're now in this nirvana of low inflation and ample supply. And of course that the pandemic kind of put an end to all that.
So when banks fails on the liability side, very often it's the case of a bank run, people withdrawing their money, either a bank run or a bank walk. The story is the same. But on the asset side, as you say, there's credit risk. People aren't getting paid back, or interest rate risk. You are getting paid back, but the money is just not worth it what it used to be because now interest rates are higher. You could get a higher rate of return. When banks have failed historically, painting with a broad brush, how often on the asset side is it because of credit losses or because of interest rate risks?
Oh, I don't think anyone's really taken that question on. But for example, in the 1930s, there's a very nice paper that was done to try to identify whether the banks were failing because of asset quality problems. That is, the banks were insolvent, right? Or it was more of a liquidity problem. So a liquidity problem is like a smaller concern than an asset quality problem. Liquidity problem, is a case where the Fed, a central bank, is supposed to come in, provide lending to get the bank over the liquidity crisis, with the understanding that because they're fundamentally solvent, you're not like bailing out a bank that really needs to be closed, right? And so what this person found, and it was Richardson was the author, is that it was kind of like, well, about half and half. Half of them were kind of really liquidity problems, half of them were solvency problems. Now, what's universally understood is that a liquidity crisis can easily turn into a solvency crisis. And that's the whole rationale for having a central bank. And that was the lesson learned in the Great Depression, when the Fed was not an effective lender of last resort. Like, no one is claiming that they were. Because they weren't, banks were selling their assets, government securities and other kinds and loans, and non-renewing loans, in order to raise liquidity to meet deposit withdrawals. And because of that, asset prices fell dramatically, so that even banks that weren't having a run on them now had a solvency problem because of all, and there's no one to buy because everyone's trying to get liquid. So that's the case for a central bank, that it is the bank that's going to become less liquid when all the other banks are trying to become more liquid.
Right. And it extends that liquidity to the system, so it itself becomes less liquid, but it makes the system more liquid.
Right. And because it issues the ultimate form of money in the economy, which is the reserves, their liabilities, we don't worry about them being illiquid.
The losses of the assets of the banks in 1930s sounds like that was on the credit side. Would you have to go to the 1980s, 1990s to sort of find banks that failed because of interest rate risks on the asset side?
Probably, yeah. And it was the thrift institutions that were really more in trouble. And with the commercial banks, actually, a lot of those failures were due to overextension in real estate lending. Mm-hmm. Banks in like energy states, and energy prices were very volatile, agricultural prices very volatile. So you had more regional banking that can be unstable because its underlying economy is unstable, right?
Right.
But these three, more recent failures is the first time the Fed, the FDIC, and the Treasury have had to leap into action since 2008, 2009. And I think that they learned a lot during the global financial crisis that they brought to bear in these three cases. But it's kind of the revenge of the uninsured depositors, is the story with these three banks.
Right. And the FDIC is it true that it was created during the Great Depression?
Yes, in 1934. Yep.
Yes. All right. Well, Professor, you got a new paper out called "Making a Central Bank Out of the Federal Reserve: A Historical Perspective on Wartime Amendments to the Federal Reserve Act." And Professor, that's a really interesting title off the bat, because sort of your previous book, "The Second Bank of the United States," quote, "central banker in an era of nation building." It has the quote central, the word central in quotes. So the second bank, not so much a central bank. But the Federal Reserve, we think of as a central bank. Oh, the U.S.'s central bank started in 1913. But you say they are making a central bank out of the Federal Reserve, that originally the Federal Reserve wasn't a central bank. What did you mean by this?
Okay. So I had always thought that from the very beginning, like from the 1913 Act, that we moved from a world in which the banks held gold as their reserves to a world in which they held Federal Reserve money, whether that's balances at a Federal Reserve Bank or Federal Reserve notes, right? But as I started to learn about the period, I realized that that was not the case at all, in fact. Under the Federal Reserve Act, what they did was they said that banks would be required to continue to hold gold in their vault, because we were on the gold standard, right? They would continue to hold gold. And the big change was, instead of holding correspondent balances, that is, deposits with another bank, another private bank, commercial bank, and calling those reserves, that those would become reserves at a Federal Reserve Bank. Okay. So it was like getting halfway there, but they would still be holding a lot of gold. And the way they set up the Fed and the rules around Federal Reserve's ability to issue additional Federal Reserve notes was very, it really constrained the Fed to playing a very passive role in the banking system. And that's why I say that they didn't really become a central bank that could become the powerful institution that it is today without these key amendments in 1917, one of which, after the U.S. entered the war, one of which said banks have to hold, member banks must hold all of their reserves at Federal Reserve banks. So you can hold the gold, but that's not going to count towards your required reserves. So what happens after that is gold becomes concentrated in the ownership of the Fed, which was really necessary for it to kind of play the role it did in helping finance the war, and then in becoming a bank with an ability to really run monetary policy. And the thing that I found was kind of interesting was I looked a lot at the correspondence among early leaders of the Fed. The Benjamin Strong, who was the president of the New York Fed, and Paul Warburg, who was on the inaugural Board of Governors of the Federal Reserve System down in D.C. So they're writing to each other, and they don't agree on everything, but they do agree that we need some major amendments to the Federal Reserve Act. And they don't get any traction until the U.S. enters the war. Because what becomes clear is that, on balance, Congress really didn't want to create a strong central bank. We still were very worried about having that much power concentrated in this institution. But that became, all those concerns became secondary when it was like, we got to go, win this war.
Right. And just to put a point on it, so from your paper in the conclusion, it says, for Benjamin Strong and Paul Warburg, the key to the Federal Reserve System's future was to own and control as much of the national gold stock as possible. So the Federal Reserve in its early years did not control the gold stock, and that was a problem. Why was that a problem? What challenges were the Federal Reserve and Fed activists who wanted the Fed to play an active role finding and encountering when they, what do they want to do that they weren't able under the original Federal Reserve Act?
Well, they were able to issue, the volume of notes they were able to issue was much greater after they owned all this gold, because they were still having to back the notes with gold. So they had a gold reserve ratio requirement, right? So that's one. And you needed a lender of last resort, or a bank that's helping the government finance a massive increase in the size of the federal government, needs to be able to expand a lot in a short periods of time. So it helps them do that. The other thing is that if that hadn't happened, and the banks were also having to hold gold, okay, the Fed is then competing with its member banks for the gold stock, right? And its notes kind of are on an equal par with gold, versus like being the number one form of money in the economy. Once they own all the gold, then there's less gold circulating. It's an important part of the U.S. moving off of the gold standard. Is that people, didn't have these gold certificates. Instead they had Federal Reserve money. So the Fed had to establish its money as being, just as good as the gold you used to use. But here's these notes instead.
Basically, what we can now consider money is the Federal Reserve notes, and those only became issued after the Federal Reserve. So the greenback, we say, the dollar started in the 1860s, but the greenback was not for the Federal Reserve notes that now is within wallets all around the country.
No, the greenbacks were IOUs of the U.S. government, and they were an important part of the monetary base. So in the paper that we're discussing, there's a lot of data on the size and composition of the monetary base. Okay. So that's a concept that, like, you have the money supply, which is the currency and the bank deposits that people use to buy stuff, pay each other stuff. Okay. But then all that money supply is based on a foundation or a base of the best money in the economy, whatever that may be. So before the Fed, it was gold, silver, and greenbacks. Okay, and greenbacks were IOUs of the federal government, and the government, those were payable on demand in gold. You could go to a treasury office or sub-treasury office with your greenbacks and get gold at the fixed price then of $20.67 per troy ounce. Okay, so another part of the story that I'm telling there is that the Treasury is kind of a quasi-central bank before the Fed is set up, okay? And it tries to carry out like monetary stabilization, especially like in the Panic of 1907. They tried to help, but they were very limited in their ability because of this requirement to keep the greenbacks convertible into gold. So there's only so much they could do without undermining the US dollar being on the gold standard. And that, we had all the fights over silver versus gold at the end of the 19th century, gold won. And the kind of predominant view at Washington, D.C., and also in the centers of finance domestically was that it was essential to stay on gold, because the U.S., to be really respected in the community of nations, had to stay on gold. And Strong believed that too. And all these early leaders of the Fed were 100% into the gold standard, right? Mm-hmm. And so having a big stock of gold in the Fed, in Fed vaults, is a big part of like elevating the U.S. internationally, and establishing the absolute dominance of the Fed's money domestically.
So to sort of graduate and come into one's own as a monetary authority, you have to have a lot of gold. If there's no gold in your vaults, why should anyone treat your liabilities as real money?
Exactly.
And okay, so how did the 1917 amendments cause gold to flood into the vaults of the Federal Reserve?
Gold doesn't pay any interest, right? Reserves at the Fed don't pay any interest. Okay. So if they were to hold they have required reserves. So if they were going to hold them all as reserves at the Fed and also keep holding all the gold they used to hold, they're tying up between 35% of their assets in a non-interest bearing form. Mm-hmm. So they're going to okay, we're taking our gold to the Fed. We're going to deposit our gold in the Fed, and we're going to get reserve balances at the Fed in our reserve account.
And reserves and Federal Reserves count as reserves now, whereas gold didn't count it at all anymore, or they just counted for much less?
They didn't count towards required reserves.
Okay.
For the member banks, they did not count.
Okay. And so how did the monetary system between 1917 and let's say 1929, popping of the great stock market bubble, what did that system look like? Commonly referred to as the Roaring Twenties, seen in general as an era where the gold standard was followed. I recently interviewed a monetary professor, Perry Merling, he's of the view, a school I'm sure you're familiar with, that the gold standard really was a sterling standard. All currencies were convertible into the pound sterling, and the pound sterling itself was convertible into gold. How accurate, in your view, in your own work, how frequently was the dollar converted into gold? No one disputes the fact that it could be, but how frequently was it actually?
Actually, I'm not sure we know that. I mean, we know something about like during the Great Depression when there was foreign holders of dollar assets wanted to convert to gold. So they would come in and a lot of them, had deposits at the Fed, including foreign central banks in Switzerland, France especially. France has always been a problem for the United States.
Why is that?
in terms of the gold standard, and because they're the ones. I mean, you've heard this expression, exorbitant privilege, that the United States has as the issuer of the global reserve currency. So that was a phrase that de Gaulle came up with, that maybe one of his big advisors, Jacques Rueff, Rueff, came up with. that they resented the fact that the U.S. had that exorbitant privilege. And they tried to basically weaken the dollar, weaken the United States by itself holding a lot of gold. So when there was a run on the dollar that led to the U.S. leaving the dollar once and for all in the 70s, right?
Leaving gold.
Sorry, yeah, and France was a big part of that run on the dollar. So, in terms of was it really a sterling standard? I guess I would say it was until World War One, and that I've read some research that's pretty convincing that in the 20s, the role of the central currency was shared by the dollar and the sterling. Then during the Great Depression, it kind of shifted back to sterling. But then obviously after World War II, with Bretton Woods and the real weakening of Great Britain as a result of, the two wars, the Great Depression, sterling just, it wasn't going to be sterling anymore. It was going to be the dollar.
Yeah. Do you think that the proliferation of commercial activity of bank loaning in the 1920s was aided by the 1917 Federal Reserve amendments because it just made banks more willing to make loans? And then also we can get into the Federal Reserve's made these technical amendments in 1917, but it continued to not see itself as the lender of last resort, as I think is the mainstream view now, which I think you think is wrong.
I haven't done a lot of work on the 1920s economy, but I think that at least it makes sense to me that if you are a member of the Fed, you're a bank that's a member of the Fed, and you know that you have access to the discount window, and as long as you have the right collateral, you're going to be able to get through a short-term liquidity problem. It makes sense to me that's supportive of lending, because if you have to stay totally liquid all the time, the only way you do that is by holding only short-term paper. Okay. But the thing is, the real economy needs longer-term loans to support longer-term kinds of investments that drive productivity growth. So, we don't want a banking system that's just obsessed with always being as liquid as it can, in my mind is not optimal.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. To what degree did the Federal Reserve see itself as a lender of last resort starting in its inception in 1913? And then to what degree did that change after the amendments in 1917?
I don't think you can even find this phrase, lender of last resort, in the Federal Reserve Act or anything like it, in terms of the contemporary. What they were supposed to do, and they did do this, they were supposed to solve the problem of shortages of currency that seemed to be endemic before the Fed and all those crises of the late 19th century, early 20th century. There were shortages of currency, to pay wages, to, for farmers to buy the stuff that they needed, to plant crops and all that stuff. And that like was shut down, parts of the real economy. So, and that was linked to the restrictions on the growth of national banknotes.
So the real economy, oh, I'm being paid, oh, I need to buy bread. There just was a shortage of actual money, which, throughout history a problem because there never was enough gold. And in the starting from the greenback era, money, what were greenbacks? It was no longer banks issuing their own currency or issuing their own paper. And sometimes there just wasn't enough dollars. There was a dollar shortage.
Yeah, and banks were issuing currency, but there was all liabilities of individual banks. All right, national banknotes. Now, the national banknotes were, in fact, fully guaranteed by the U.S. government.
Because they were backed by the Treasury debt?
Well, in part because of that. But the Treasury said, if your bank fails and you're holding that bank's notes, if you come to the U.S. Treasury, we're going to give you gold equal to the value of your notes. Okay. Now, the U.S. government had collateral of the U.S. government debt that it could sell to help pay for this guarantee. Okay. The bank deposits of the national banks, nationally chartered banks, were not guaranteed. Okay. So that's why you had runs, why people wanted to, because the currency was completely safe because it had this Treasury guarantee. Okay. But that said, during these crises, shortages of currency would develop, and the Fed was created to make sure that there was always enough currency, there was an adequate supply of currency when there were spikes in the demand for currency coming from whatever reason. Okay. And the way a bank would get more currency is by going to member banks, go to the Fed, and either take out a loan and get the currency, or they take their reserve deposits and say, I want to cash these deposits. Give me currency for these deposits. And in the Great Depression, the Fed did a very good job at that. Okay. But it's another example of like fighting the last war. Yeah. Because then there are all these other new problems that it wasn't responding to.
Right. So that's super interesting. So right now, people who have liabilities of banks, they have a different stack of who gets paid first. So who gets paid last? Equity holders, stockholders, then preferred stockholders, then bondholders, and then depositors. Depositors, and particularly insured deposits below the $250,000 limit. If you have $249,000, that is safe no matter what. Interesting variant. I didn't know this, that in the 19th century, to a great degree, that was the opposite, where if you had owned a bond of the a bank or a note of the bank, that could be guaranteed, but not deposits. And that's why you had all these bank runs.
Yes, just the notes were guaranteed, not the bonds, not the debt. Banks didn't issue a lot of debt at that time.
Okay. So what's the difference between, a depositor and a note holder?
A note holder would be someone that held the currency issued by a bank.
Okay.
Versus holding a deposit in the bank.
Okay.
And the thinking was that because not everyone had a bank relationship, right? So a lot of people would just use currency in all of their economic life. It was just currency. And it was thought that people that used currency on average were, less well-educated, lower income, and they needed protection, Whereas the depositors, there's probably more businesses had deposit accounts. So the thought was they should be able to differentiate between good banks and bad banks. All right. And so that thinking is still with us. It's still with us. So in all this conversation about these three bank failures, there's this idea that, well, maybe it's time to insure all the deposits. Yeah. But people are saying and there's, debates about this, because you'll have lots of economists that say that is a bad idea, because you need the market discipline from those uninsured depositors.
Yeah, the parallels are really jumping out at me. So Silicon Valley Bank failed in early March, and not only was the depositors under the FDIC limits guaranteed, but deposits beyond that were guaranteed. I think 2 days after the Sunday on I think March 12th, and that is that new, and also the degree of question of moral hazard of should depositors be sort of playing the role of a cop who are regulating banks, and if you own a certain business, if you're a farmer, a large farmer, I mean, should you be doing independent credit analysis on your bank, and then if it's not good, you're leaving you're putting your money somewhere else? Is that a truly good model? And yeah, I mean, how has this thinking changed throughout American history?
Clearly, initially the limit on insured deposits was $2,500. Okay, much lower price level than all that stuff, and it gets kind of adjusted up. But it was never the thought that we would insure all the depositors, because you wanted some depositors thinking that the entities that had larger deposits would have the capacity to discern, to get the information needed to differentiate between good banks and bad banks, right? And provide that market discipline. Okay. So there were very, very few bank failures until the 80s and 90s. Okay. So it seemed like, oh, this is great. Deposit insurance has solved the problem of bank runs and that cause bank failures. Okay. So then we get into the 80s and 90s, and we've got banks failing, really more for asset quality problems. Like they overinvested in commercial real estate or, energy, agriculture, all that stuff. Okay. But then it's up to the FDIC to figure out how to so-called resolve all these bank failures. And they end up resolving the bank failures in ways that almost always ended up protecting all the uninsured depositors. Okay. And there were no bank runs. There were bank failures, but no bank runs. Because they did this thing with, we're going to take care of everybody,
I just want to, so in the 80s and 90s, when banks failed, you're saying for mostly on the asset side, the FDIC hinted that they would take care of uninsured depositors, or they actually did. In other words, there were uninsured depositors who, based on the framework of the 1934 FDIC Act, should have been exposed to risk, had their capital at risk, but they weren't because of the FDIC. That's what you're saying.
Right. And it happened through these purchase and assumption agreements that the FDIC entered into. So a bank gets closed by its regulator, by its primary regulator, okay, which could be a state agency. Then that agency almost always designates, if it's an insured bank, the agency designates the FDIC to be the receiver. Mm-hmm. Okay. So then the FDIC is like, okay, now what are we going to do? And in a straight deposit payout, this is like the hardcore, we're going to insure the insured depositors. And then we're going to liquidate the assets of the bank. And then once we know what we're getting for the assets, we will, we will pay off as we can the uninsured depositors. Then there will be that priority, like you were talking about earlier. Mm-hmm. The shareholders are at the bottom of the list. Okay. So in that scenario, probably maybe the uninsured depositors get, 50 cents on the dollar, something like that. Okay. So the people who really believe in market discipline would say, that's what you need to do, because people will learn their lesson, and then we're going to have a stronger system of market discipline at the end of the day. If they'd done that, probably the banking crisis would have been a lot worse, because the word would have gotten around that uninsured depositors are taking losses. So instead of doing deposit payouts, the Fed would look for bidders, look for banks that
The FDIC.
The FDIC, thank you, would look for bidders, and they would make the deal sweet by saying the FDIC will take the bad assets that you don't want to take, as long as you take all of the deposits, the insured deposits and the uninsured deposits. So the uninsured depositors get protected by being now the depositors of a healthy, successful bank.
Yes. And that is what happened with First Republic got taken over by JP Morgan. JP Morgan took over virtually all of the assets and virtually all of the deposits. The stockholders of First Republic basically got wiped out, as well as the preferred equity holders. But the system worked for there. But I think in the case of Silicon Valley Bank, the FDIC could not arrange a deal fast enough. So they did instantly declare, I think on that Sunday, that all uninsured depositors would be taken care of. And I think they did that for Signature Bank, which they closed and announced upon on the same day.
Exactly right. What was so interesting about the Silicon Valley, well, they're both fascinating, but with Silicon Valley, on the Friday, the FDIC said it's a deposit payout. We will let the uninsured depositors know what they'll get after we liquidate the assets. By Sunday, they're like, now we've declared a systemic risk exception, which requires the approval of the board of the FDIC, the board of the Fed, and the Treasury Secretary. And the Treasury Secretary has to consult with the president. So, which kind of gets the president off the hook a little bit, They have to talk about it, That's probably smart. I don't know. So by Sunday, they're worried, though, about the run, about this thing spreading to other banks, because they realize how many banks have a lot of this long-term, have this maturity mismatch, and have a similar problem, maybe not as big a problem, but a big enough problem. They say we're going to guarantee all of the deposits of Signature in Silicon Valley, and we're setting up a new lending program for members that might have a problem, and that allowing banks to borrow up to a year. That's a very long term for a lender of last resort program. So that's kind of a pattern I see often with these crises, is that there's a sacrificial lamb. There's somebody that goes down first. The authorities let it go. Then they say, oh, whoa, this looks bigger than just this one bank. And then they put in place new lender of last resort programs that help everybody else.
Right. So that bank term funding program allows banks to pledge a certain set of assets, not all assets, and get loans with a duration of up to 1 year on it. So it allows them to tap liquidity. But it's my understanding that the banks that hold the greatest percentage of paper that is eligible, collateral that is eligible, are the big bank, because they own a lot of agency mortgage-backed securities and on all these sort of Tennessee Valley bonds and stuff like that. Whereas the small regional banks, they own a lot more loans and whole loan mortgages, which can be eligible for federal home loan borrowing, but not the BTFP. So a moment that kind of went viral was someone from Congress, from Arkansas or Oklahoma, said, "Hey, Treasury Secretary Yellen, you bailed out Silicon Valley Bank, which, by the way, headquartered at the San Francisco Fed, where you used to work. Are you going to do the same thing for the uninsured depositors in my district in Arkansas?" And she did not give a super clear answer to that. How are you thinking about whether the FDIC will continue to extend uninsured deposit insurance to banks that may fail in the future?
Yeah, that's a good question. I just want to add something about the bank term lending program, which I think is very interesting. So it allows banks to post collateral in the form of the long-term government securities. And they're allowed to value those securities at face value, not at their market value.
Hmm.
And that's why Silicon got in trouble. They had to sell and take the losses, and its assets shrink and becomes insolvent. So I don't know. I just keep thinking, well, if that had been in place for, Silicon Valley, would it still be a bank? Yeah, I know it's like, bad form to get too upset, about banks. But Signature and Silicon both did some pretty good lending, and there's a loss of credit intermediation services. I go back to, they didn't have loans that weren't getting repaid.
Yes, that is so correct. And sometimes I see people in the media stating that their loans went bad, but they didn't. I have said this many times, but yeah, their capital call, their main business line had, I think, one loan go bad in the history of the 30 years of doing business. It was that interest rate risk management, which they did extremely poorly. And the counterfactual that you posed, I think you're right. I mean, they owned over $100 billion of mortgage-backed security, which we know is eligible for the BTFP program, and which we know could be pledged at par. Which
Yes.
is I'm glad you reminded us of that, because it is a huge factor.
Yeah. It was definitely, it was very responsive, but it was too late to help Silicon.
Yeah, always fighting the last war. So yeah, how are you thinking about FDIC insurance? Because you said in the 80s and 90s they didn't do the sort of hard sale, but they did engineer a merger, a takeover with a different bank. This is a step different. This is saying, actually, no, deposits over $250,000 are going to be fully taken care of. I mean, you had venture capital backed companies, famous names, that had a $5 billion bank deposit, and they were, saved.
Yeah. I think that strictly speaking, those deposits were sitting at the bridge bank that the FDIC sets up after they close down the bank.
Mm-hmm.
And so it kept those. I mean, in a way, it was good for the FDIC too, because it keeps those deposits there at the bridge bank.
Yeah.
Yeah. I mean, that's a big question. I mean, and it's a question really for Congress, because the FDIC needs the law to change for it to start to insure all the deposits. And after the 80s and 90s, Congress was in 1991 adopted the FDIC Improvement Act, which sought to re-inject market discipline from the uninsured depositors. And it tried to kind of tie the hands of the FDIC in terms of when it could, but by saying that if the FDIC is supposed to resolve a bank with the least cost to the deposit insurance fund, even if it means not covering all the uninsured depositors. So before that, the FDIC was really focused on stability, right, versus market discipline. And you could, you can see why, there's a case for that, right? Because it's hard to predict just how bad things are going to get. And severe financial crises impose huge costs on the real economy, in terms of unemployment, people losing income, people losing their homes, people losing their businesses, and you got to weigh the cost of undermining market discipline with the cost in the real economy of people losing income and wealth. But after the 1991 Act, Congress is like, really, we really want you to be, get that market discipline back in there. So the question now is like, what is Congress going to say?
Professor, I'm actually very lucky to say I actually will be interviewing the former head of the FDIC, Sheila Bair. So if you have any questions that you can direct to me that would make it seem like I have the knowledge of a monetary professor history of FDIC, either on camera or off camera, I'd be very, very grateful. In the meantime, I want to ask you about the systemic risk exception. What does that mean exactly? And to what degree is that related to the 13.3 part of the Federal Reserve Act, which I think allows for unusual and exigent circumstances?
Yes. Okay. So they're kind of similar, but obviously one applies to the Fed, the latter, and the former applies to the FDIC. under the systemic risk exception, it says that's an exception to the rule that you have to do the least cost resolution. So it says if you declare a systemic risk, then you can close a bank in a way that is not the least cost way to close the bank, and that also covers uninsured depositors. Okay. However, if you cover the uninsured depositors, you can't, it's not the taxpayer who's going to pay for that. It's the banks, the surviving banks. So, I mean, I think an important point that people understand is that the banks pay for the insurance. The taxpayers there is kind of a backup, a line of credit. But, and this would be a question for Dr. Baer, which is, has the taxpayer ever actually had to cover uninsured depositors? I don't think they have. It's there in principle, but they've never wanted to use it. And even in the global financial crisis, the banks did not draw on their line of credit. They found a way to get the deposit insurance fund up from negative into positive territory without going to the taxpayers. Because they know, I think they just know that's just political death.
Yes, that is a really good point, and that is a fantastic question that I will be sure to ask Dr.
That's great that you got her. I'm a big fan of hers. I think she's really got a good take on things.
Yeah, me too. So that's the systemic risk exception for the FDIC. The 13.3 Act for the Federal Reserve. Tell us about that. How much of that is new, or was that all in the 1913 original?
So that was amended into the Federal Reserve Act in 1934.
Okay.
Very interesting timing, the same year that the FDIC is set up. So I think that what they realized was one problem in the Great Depression with the Fed being able to respond to the problems that the banks were having is they had very limited collateral requirements. We were talking earlier about this for a loan from the Fed. And a lot of the banks that were in trouble, I mean, it started out with the little rural country banks with a lot of long-term loans to farmers and ranchers, right? Who are actually producing the food that we all need to survive. Okay. Mm-hmm. And those guys need longer-term loans. So they were very illiquid. And they didn't have the right collateral. I mean, a lot of them weren't members anyway, problem one. But even those that were members didn't have the right collateral, so they couldn't get discount loans. So some smart lawyer got that in there, and the Fed's been using it as needed to kind of say, if we have a situation on our hands that no one could have ever predicted, so we need to do some new things. They use it extensively in the global financial crisis, of course.
And what does the 13.3 Act exactly allow the Federal Reserve to do, or is it somewhat of a blank check? You can do whatever you want.
It's kind of a blank check.
Yeah. So the totally new and unprecedented monetary policies of March 2020, April 2020, where the Federal Reserve lent against commercial paper, they set up a facility to buy high yield bonds. All of that sort of what before the crisis would have been seen as radical acts that was justified by the 13.3 exemption, right?
Exactly.
Okay.
Exactly. Now, when Bernanke and others kind of defend the Fed, they kind of say we're kind of hamstrung by the law. Okay. But in my financial history class, we read a book by Gorton and Tallman called Fighting Financial Crises, which is a good book. I recommend it. And one of their lessons is during a financial crisis, you should go ahead and break the law. Like before the Fed, what would happen when there were runs is the banks would just suspend specie payments. They would just say, we're still open, but we're not going to give you our gold. And it was like, and we'll let you know when we resume specie payments.
So it was even worse than a bank run. There was a bank run, but people just didn't get their money back. And that, I guess that's the, It's a Wonderful Life scene where.
Yeah.
Yeah.
Well, people could still use their bank, right? They could still use their write checks and deposit checks and stuff like that. They just couldn't get gold or greenbacks.
Professor, earlier you said that the Fed did a good job during the Great Depression of its original purpose of supplying ready currency, but they did not do a good job of being a lender of last resort. Could you just explain that difference for us?
Sure. So if a member bank had a jump in the demand for currency in its local economy, okay, it could go to the Fed and get currency. Okay. And the Fed met all of those demands for currency that came from banks. Now, they had to have enough, a big enough reserve account to get the amount of currency that they wanted, and they needed to have enough good collateral to borrow the currency, if you will. Okay. But from just a basic physical point of view, the notes were there. And they'd produced enough notes in advance, like right after the Federal Reserve Act. You read about them. We're printing a bunch of notes.
We're doing our job.
We are going to have stacks of notes back here. Because what happened during the before the Fed was banks would try to get more notes. These are notes, their notes, national bank notes. But some of them are saying, but it took 3 months to get more notes because it's this huge bureaucratic process.
Yeah.
And they literally had to print more, and it just took time, And there's all these administrative steps, like to prove that you've deposited your government bonds and you've put gold into this redemption account. And I mean, in a banking crisis, you need to get it now.
Yeah.
Yeah. Okay. So, but the lender of last resort is, what I mean is that there were a lot of banks that failed because they had runs on their deposits. And some proportion of those failures could have been prevented if they'd been able to borrow from the Fed. Okay. Either directly from the Fed or through a bank that was a member of the Fed. Okay. And the Fed, and also the Fed is criticized, this is Mike Friedman and Schwartz, that the Fed allowed the money stock to contract, allowed the price level to fall, and didn't recognize that they needed to be buying government securities and kind of flooding the system with reserves, with new reserves. It allowed reserves to kind of be stable instead of just really expanding the monetary base. There's probably something to that too, because expanding the monetary base helps all the banks, not just the banks that belong to the Fed.
Right. And now it isn't the case that the monetary base is shrinking because of quantitative tightening.
Yeah, it is definitely it's shrinking.
Yes,
as it needs to.
And so we say as it needs to. Why is that the case? Because we have inflation?
Well, I just think that the system had. I mean, I don't really think that having all the money has been inflationary. But I think that the Fed loses control when there's so many reserves in the system, because it means that banks can go and they actually have no reserve requirement anymore.
Yes. And they have to pay money on the reserves now.
And they're earning interest on the reserves. Yeah. And it's like the Fed actually has negative net income right now.
Yes.
None of this makes any sense to me.
Just to put that in context, I was reading your excellent book about the Second Bank of the United States, just flipping through it today, and the Second Bank of the United States earned something like 4% on its assets.
Yep.
So it was very profitable entity, and you compare that now to the Federal Reserve, where they're paying the interest on excess reserves rate or reverse repo rate, which are very similar. Could actually do the Fed funds rate of now let's say around 5%, and they own all these mortgage-backed securities and treasuries that they bought in spring of 2020 that are yielding 1.5% or 2%. So it really is, and so you spend a lot of your time in the world of the 1800s, the second bank. So I can understand why what is going on now with the Federal Reserve seems so foreign to you.
Yeah, definitely.
Because it is.
But they're not booking it. I mean, they don't show their capital going down. They're booking it somehow as an asset.
So a negative equity position, I think.
Yeah,
it's called.
something like that.
Yeah, so that really is remarkable. So, Professor, the last topic I'd like to approach with you is the debt ceiling. How much Congress allows the Treasury to borrow, I think. When did that practice become? When did Congress sort of place handcuffs on the Treasury's ability to spend or borrow? And then I was put that in the context of, for much of America's history, it was a surplus nation, not a debtor nation, meaning that it's exported more than it imported.
Yeah, that's a great question, and important piece of history. So the debt ceiling dates from the early 20th century. I don't know the exact date. Okay. And maybe like shortly after the Fed is created, but I'm not exactly positive. But what I do know is that before the debt ceiling, the executive branch had to come to Congress every time it wanted to borrow money. So the debt ceiling was like, at the time, it was like that was an improvement. Because it was like, you can borrow, you can just manage the debt, you can do what you need to do to run the federal government without coming to us every time you need to borrow. See what I mean?
Yeah. So the debt ceiling now, people say it's just a chain on our neck. It's so bad. You're saying it was an improvement relative to any time the Treasury wanted to borrow, they had to approach Congress.
Exactly. So it was actually an improvement over the way they were doing it, right? So from their point of view, we still want to have, some limit. This is why you had to come to us every time to make, we wanted to, because we're in charge of the fiscal soundness, right? Really, Congress is where the budget is made, not the White House. But of course, it's turned into something quite different. And they historically, every single time the ceiling is lifted, it's just a question of how painful it's going to be.
Mm-hmm.
But right now, it's a game of chicken, a very dangerous, destabilizing game of chicken, because as you know, U.S. government debt permeates the financial system in terms of collateral for all kinds of large wholesale financial transactions, and that are resting on having this safe asset as collateral. And if that's no longer safe asset.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto. A smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code GUIDANCE10. Thanks, and let's get back to the interview. We started this conversation talking about the transition of what was money, what were greenbacks issued by the Treasury, sounds like not interest bearing, and that gradually what became money was the Federal Reserve note, which we still carry in our pocket. So for everyday transactions, money is cash, but now really bank deposits, credit cards. But in terms of large institutional investors, what is it accurate to say that what is money now are treasuries?
I would agree with that.
Yes. And those are at risk of, at least on paper, defaulting if Congress does not get its act together.
Or the interest rates rising, and so the face value goes down.
Yes. And have you followed this theory of the $1 trillion coin?
I have a little bit. Yeah.
Okay. Yeah. What do you make of that theory that, okay, Congress isn't going to, the Treasury is not going to issue debt. It's going to produce this coin, and the Federal Reserve can buy it for $1 trillion. And it will be a very high quality platinum coin, so it'll be worth so much as a workaround.
I mean, it makes as much sense as the Fed buying government debt and just creating reserves when it buys the government debt.
Yeah.
It's finding some asset for the it has to be an asset owned by the Treasury, for the Treasury to be able to deposit it in its account at the Fed. And then it has the money that it needs to cover the Social Security checks.
Yes. So is it safe to say on the plumbing, anything can happen in the same way that, in the 1920s, the Federal Reserve owning U.S. Treasury debt was seen as ridiculous, and now it's extremely commonplace. Anything can happen. What analysts should, when think about it, is the consequences. Does this make sense? Not the plumbing.
Yeah, I mean, if you have to do it to avoid a default, I would say do it. Right?
Yes.
The fundamental problem is that Social Security and Medicare have to be put on a long-term solvent basis. And they're not. I mean, already the Social Security has operating deficits and is going to run through its surplus within 10 years. Okay. So the debt crisis is fundamentally a governance crisis, in my view, because we don't have enough of a governing center of people in Washington who are going to be able to get together and say, okay, let's just solve this thing once and for all. And then people globally will say, okay, these are people who can take care of their fiscal problems.
All right. Well, on that cheery note, Professor, we'll leave it there. Thank you so much for coming on. Two final things. I don't think you have a Twitter account, so where can people follow your work? And this paper that we discussed, which again is called "Making a Central Bank Out of the Federal Reserve," that was released last fall. What are you working on right now?
So right now I'm back to colonial monetary history, and there's a conference in Portugal. In fact, I have to right now go figure out what I'm saying in this paper about the bills of credit, the first paper money issued by Massachusetts purportedly the first paper, not really, but Gerard Goldberg has a new book that is very interesting about the Massachusetts bills of credit, and I'm going to have a little different take on it.
Okay. Not
really money, in my view. Not money.
Why not money?
Because the money was specie, was silver. People thought that was money. This is like a treasury bill. This is like a short-term treasury bill. It's government debt.
Where can people find your work?
I guess my website. I don't have a lot of that. Paper's not open access, which is kind of too bad. But it's published in Review of Political Economy.
Yes.
And it's a special issue on the progressive era. So I think there's going to be a lot of interesting work in that issue.
Yes, but you're making a central bank out of the Federal Reserve. I found it, and I recommend people follow in my footsteps and find it online. And of course, the book "Second Bank of the United States" is a must read. We put it on there. Professor, thank you so much, and talk soon.
My pleasure, Jack. Take care.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.